Good morning. I'll wait for people to come in. Good morning. Let me know how the sound is. Hello, Tanya. I just realized I neglected to send you the clean version of the notes. I do owe you that. So how's everyone doing? Tanya, I think it's only us. Let me see what's going on. People are starting to come. Hello. Hi, Paula. Jose. How's everyone? Saludos. Lots of work, I know. Not just my class, right? I'm not the only guilty one. Other classes too. Good. Let's all be positive and it changes our perspective. Just be positive. We're almost done. There's a lot of work, but you're learning. Always take the positive perspective because it's easy to get so stressed out. Okay, we're 10 minutes in. Should I just get started? So I'll just begin with a summary, right? So last week we finished learning all the essential statistics we need to cover the topic of risk and return. So I started to plow through the notes and ask you to check things now that you know what I expect from you. If I say mean, if I say variance, ex post, ex ante, you know how to make calculations. And we're really focused then, you're going to work on the calculation because that's statistics, and I'm going to help you with the interpretation, which is finance. Uh-oh. I hope I don't have a problem with the software. Let's see. I'm not sure why it does that. I do have a lot of files here, but oh geez, might have to dump some things. See if that helps. All right. So that's not good. This shouldn't be happening. I have a very powerful computer. iPad. But it might be from just typing. Writing. It's a lot of storage. Get rid of this. That might have been a big file. Oh no. Okay, sorry you're watching me housekeeping. Oh, so we talked about this, did we? No, this is my other doc. Oh, I have all the marks. Actually, that's not a bad thing. All right, so once we have, so now we have, I asked you to look and verify these numbers. If you haven't done it, make sure you get around to it and verify that the mean of this data, terrible. The mean and the standard deviation you can calculate using the formulas, but I've just put R in here. Now in a test situation, we only have one more test, so you're going to have to write out formulas if I ask you to calculate things, but the final answer is all I really want. I want you to demonstrate that you know which formula to use, but you can use your calculator as I showed you to get your final answers, like this one. And this is bad. Let me see if I can use a different document. This shouldn't be happening. This one's marked too. Okay, I'm just going to recreate the document. This is insane. Okay, so once we have the mean and standard deviation, as I taught you, you can use them in a give or take methodology, assuming, because they are returns historically, a historical set of returns, we know, and this is what you have to assume then, that they are normally distributed. Okay? And even though I only use 4 values here, and it's too much to say normal distribution, I just practice calculating mean and standard deviation for them, but I'm going to actually use the whole data set to make my normal distribution, because I'm confident that the S&P 500 returns over 88 years is normally distributed. And in this case, I have the data that I put in the notes. The mean is 11.4%, so about 11% historically on average, with a standard deviation of 19. So that's quite wide, right? This number is bigger than the mean. So within 1 standard deviation, you're in negative returns. You see that? So then what I did here was created the probability, the normal distribution curve, so you can see that within 1 standard deviation, the returns are between like a negative 8.3% to 31.1%. So that's 68. Let me erase this. Oops. Do not erase. Okay. Well, between here and here, 68% of the observations, that's 1 standard deviation. Just to reiterate, these numbers are for the whole 88-year data set, not just the 4 that I plucked out. And the chance of being around the mean, right? 1 standard deviation around is 68%, and 1 standard deviation around goes from an interval of negative 8.3% to 31.1%. So already within 1 standard deviation, you could have a negative return, but you could also have quite a high return, 31.1%. Where are you going to get 31.1% return on your dollar? Not at the bank, right? That's a really high return. So these are risky returns, noting that it's a wide standard deviation. The larger the number of the standard deviation, the more volatile or more risky, right, the returns. So you could get low, but you could also get high returns. Then you can break it up some more. Within 95% of the observations are within 2 standard deviations. So that brings me between negative 28% and 50.8% return. So that's quite broad as well. And then with that, I can ask you questions. So basically, once you know the mean and standard deviation of a set of returns, I can ask you to make interpretations. I can ask you questions like, what is the chance of positive returns? 1 second, let me make this a little bit. Let me make it a little bit better to see. So what is the chance of positive returns? So positive, and I say approximately. What I'm trying to say is somewhere, like roughly, it looks like you'll have positive returns more than 50% of the time, right? Because these are all positive returns, this half. But then there's a little bit more here. So the best I can do with my assumption of normality is speak about the broader tick lines, unless you want to go using your standard normal table to make to standardize this question and compute the true value. I'm not going to get into that, just approximately. I know it's between 50%, which would be from here on, to, you know, half of this would be 34, so I just added that to 50. That's what I did. So I say here, that did not work. More than 50%, but less than 84% to answer question 1. And then I explain how to do that here. Then I ask, what is there any question about that? Did you follow my graph? Then what is the chance that the returns will be less than -30? So -30 approximately starts here. So then I figure out that marks 2 standard deviations. So 95%, I'm going to use a different color. I'm going to use this color. So 95% brings me to here. If it's 95% in between, then it's 5% outside. So that makes 5% divided by 2, which gives me 2.5 on either side. So now that I have that number, I can say that the chance of being out here is less than 2.5%, right? Because 28 is not even 30 yet, so -30 would be about here. So it's less than 2.5% chance, but more than 0. So that's the second answer. Any questions about interpreting? So this should be familiar. If it's not, this is not hard, right? I just get a mean and standard deviation, make the curve, and then know the properties of a normal distribution to draw conclusions. And that's the most I want you to do with that. So that is true for common stock returns over time. I'm not going to be able to change the page. All right, so what I did here was, this is this data set available from the source provided, and what I show you here are different histograms. So remember, we have histograms, or relative frequency histograms, under the normal curve, and I talked about smoothing out. You see, it's not so smooth, kind of goes bump, 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 bump. But what I would do is smooth that out and say, well, it's approximately normal. That's what I do. I say approximately normal, and I imagine smoothing this out, something like that. And I talk about the center being roughly, you know, somewhere like here. The point is, when you go down, 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 it's bigger than 0. And in terms of historical, we calculate 11.7%, or I give that to you, and this is the standard deviation. I did not want to do that, but I want to see. Anyway, so that's for large company stock. Even more risky would be small company stock with a with an average arithmetic mean of 16.4 and a standard deviation of 33%. Notice how much wider it is, flatter and wider. This is capturing the greater volatility, even though the mean's a little higher, right? It's a little bit higher than the mean for large common stock, but then it's much more volatile. This is higher. So that's important to notice. You can also smooth out that curve. And so you see, again, sticking with large data set, because if we have a small data set, we can't assume this. In fact, we noticed in the small data set that we had in the notes that the geometric mean and the average arithmetic mean were different. And I told you if they're different, you should use the geometric mean. And the difference is denoting that it's skewed up. It's not normally distributed, okay? It's not a regular predictable pattern. So that's why I went to the larger data set. All right, so what do we see? So more risk, at the same time, higher return. So you should have seen this before in 3106, but if not, now you're learning it. So what we see here is that, and how we interpret this is, we can get higher returns in small company stock, higher returns, to compensate for the additional risk of small company stock. Okay? That's how we would interpret that. Ultimately, what do we compare these returns to? The average investor, the rational investor, will want to preserve the value of money. And one thing they have to beat is inflation. And the one thing that does beat inflation are treasury bills. We use treasury bills as the benchmark. Any rational investor will be investing in treasury bills, and then with a standard deviation of 3.1, that's dramatically, it's a tenth of what you get in small company stock returns in terms of standard deviation. So this is low risk. We actually refer to US Treasuries as risk-free, and I use the notation RRF for risk-free return. And we use it to compare other asset classes. So for instance, large company stock has an average return of 11.7% to compensate for the additional risk over and above US Treasury bills. So that is known as a risk premium. This additional return is known as a risk premium. You calculate it by just taking the return for any stock minus the risk-free rate. So let me erase that. It's nice and big. So for large company stock, the risk premium is 7.9%. This is the higher expected return to compensate investors as a compensation of investors to take on this risk. Now this is something that's born out of market activities, right? Many buyers and sellers of the underlying stock, and this is just born out of the market. It's not like someone makes this calculation and says, personally, I want to get a 7.9% higher return than treasury bills. This is what is born out of market activities. So, and again, many buyers and sellers interacting. All right, so similarly, I can calculate the risk premium for small company stock, and that's taking 16.4 minus 3.8 to get 12.6%. And then, so then those are the stocks. What about the asset class of long-term corporate bonds? Now, long-term corporate bonds are less risky because as a bondholder, bondholders have a certificate of indenture and they have a commitment from the company to pay them a return. And they have a commitment either with coupons or they have a discount bond, they get a return that's implicit in the bond, and they have therefore less risk. So this is much lower, but it also comes along with the lower return. So the risk premium for holding corporate bonds, long-term corporate bonds, is 2.4%. Even less risky are long-term government bonds. These are backed by the government, meaning the government can increase taxes to increase revenues to pay bondholders. So this is borrowing money by the government that is guaranteed by their ability to increase their revenues to pay those bondholders. So long-term corporate bonds are not too far off though, right? In terms of return and risk premium. And there's a little differential here. Looks a little more risky. The whole long-term government bond. Okay, so then what you see is these are lower because these are lower returns on average than being up here. So you take, again, the higher the return, the more wide you'll see the distribution of returns. And then what I did, so if I ask you for risk premium, you can calculate this. Remember everything relative to the risk-free returns, even though this is not zero, this is how we refer to treasury bills in theory. And this is just another data set. I added more data. I did this myself using more updated numbers. And you see still the return is about the same, 11%. And I just recalculated everything. So you could see the histogram. You see this is much higher than zero. Government bonds, much lower return than common stock. And then treasury bills are not even normally distributed, because you can't get negative returns on treasury bills, or at least historically you haven't. Okay, any questions about this? I'm going to close this file if it's causing me trouble and hope the next one doesn't. So you should be able to make those calculations and those interpretations. That's what you really need to be able to do. So then I gave you a bunch of handouts with answers. Any questions about these problems? I gave you 5.10, 5.11, and you're supposed to practice. So are there any problems in here that anyone wants me to do? Or are you guys good? You're going to work on it if you haven't already. Give me some feedback. No comments? Uh-oh, what's happening? Yeah, you can see my slide. No comments, no questions. How many of you have worked on these problems? Has anybody worked ahead? You guys can brag if you worked ahead. Let me know. You can be proud, although it's difficult. I know we all have lots of work. You guys need to practice because this stuff is going to be examinable. So I did give you all the answers for this material. You just have to practice making calculations. And there's some challenging things in here. What I can do, well, I guess we're going to meet on Friday anyways, so if you have questions, you can ask me on Friday. Or even before. Okay, I am still working on them, but if I have doubts, please send me emails. Yes. Okay, so you didn't work on it. Just being honest. All right, so look at those. You should be able to do those problems in 5.10, and you have the solutions in 5.11. And then 5.12. Are the new notes. Great. So I'm going to pick up with 5.12, and these ones are clean, I believe. Let's see. I have them marked up a little bit. Okay, that's all right. I don't know. Let me see if I can give me a minute, okay? Okay, I found the clean file, and then okay. All right. I sent you the clean documents. Maybe this will work better for me as well on my end. I emailed them to you. Okay, so if you feel like I'm going quickly, you're going to need to take some time this weekend to sit and go through the notes and realize you have all the tools you need to read through the notes. I'm highlighting the finance results, all right? And honestly, much of this should be review, but I'm just going much deeper than maybe you've seen before. Okay, so what we're going to do next is the capital asset pricing model. So what is this about? Our goal, as you might or might not remember, of this unit or this module is to come up with a way of computing the appropriate risk-adjusted rate of return. So basically we're working on our goal is to estimate the I that we're using in our formulas, the required rate of return. And I refer to it, let me write it a little broader than that, and I'm going to make this big. So you want to find the best I for the firm in valuing projects or in for investors valuing assets like stocks and bonds in a company, in a corporation. Okay, so we realize to make good or value maximizing financial decisions, one must understand the relationship between risk and return. We accept the notion that investors like returns at the same time that they dislike risk. Okay, so it's not just a matter of looking at these numbers and making the point that higher risk is accompanied with higher returns. It's that's because of preferences, right? So the existence of those assets is because investors actually will only invest if on average they get a higher return for investing in the more risky one. So consider the proxies for return and risk. We use, to measure return, we use expected return, and to measure risk, we use the variance of returns. And notice I'm going to move now from ex post, like historical data, and I'm going to move into the ex ante, the prediction kind of distributions of data. And so this is the example that I begin with. We're going to make some calculations here and then some other examples. Don't lose sight what we're doing. You've seen this formula already. When you have ex ante type data where you have 3 possible outcomes and these are their probabilities, this is a distribution. This is a discrete distribution that was derived using historical data, predictions of the future, perspectives of these firms, or in this case, these are returns to, this is just in general. These are the returns for the economy. Have I said return figures for following year on stock? No, this is for this stock. So all this information was used for the estimation of the returns on the stock. The different states of the economy were incorporated, and what you have here is a discrete distribution of returns. we know how to deal with that, right? We know how to deal with that. Remembering weighted mean and weighted standard deviation. So what I have to do, remember, is pre-multiply each return by their weight and sum them. I don't have to divide anything because these are already fractions that are pre-weighing the returns. So I make a table to demonstrate that. And you can do the same sort of thing in Excel or by hand. So you're going to multiply those across and sum to get 15%. Sorry, I'm just making room. So that's what you get. So that's my answer here. So this should look familiar. And remember, I gave you the formula sheets and I just use R's for returns in place of X, which would have been for the variable in statistics. That's the symbol you usually see. Questions so far? So the expected return for this data set is 15%. Or we say the expected return to stock for company XYZ for the next year is 15%. What about the variance? So we need the variance, and then from there we get the standard deviation, and it's this long formula. But again, use tables. Using tables and Excel, you can build tables, and you should practice that if you haven't already. So what you have to do is it's the deviation, this average square deviation from the mean. So I need the deviations from the mean here. And then I weigh them and sum. So I have to weigh the square deviations from the mean and sum them. And that's what I do, and I get this 14.14%. Okay, so you have the mean was 15, if you remember, and the standard deviation after you've taken the square root of the variance is 14.14%. Notice I don't put symbols here, right? Because variance has no units. The standard deviation does, so we use standard deviation. All right, questions so far. So all I've done is calculated the mean and standard deviation. You should practice this, as I said. So here are the weights, and here are the deviations from the mean. So I had to take each return, which was in the other table. Let me copy those over. I'm going to copy them over and remind you what we're doing. So it's not on this table because I needed to fit it, but it didn't fit nicely. So here it is here. So this was like, those were the returns. And that's how you calculate them. So you have to take return minus the average return. And then square it. You guys want me to do this in Excel? Okay, so the state. All right, let's see. So what was done was, I mentioned the analyst would take information about historical returns, information about the company's historical returns, and information about perspectives of the company, and information about the future expectations in the economy, and all this information rolled into one, and they come up with, if there is a normal state, let's say this is an expansionary, it's like a very, not an exciting return or growth or productivity, 1% change in the gross national product. So this is a 1%. So if this economy reflects a performance of increasing productivity by 1%, then the returns to this company are negative. So it looks like this company doesn't do well in a weak economy. Okay, so stronger state of the world, state of the economy, the company does well, 15% returns on individuals owning the stock. And also for the company, right? This is shared by the company. So this is a result of profits, for instance. So then also 3% change in the economy is quite good. So this is like an average state of the economy, better state of the economy, and this is a expansionary state of the economy. So these are all just different states. And of course, these are only 3. I give you 3 so you can make the calculation, okay? But really, there could be infinitely many states of the economy, but that involves a different approach. You would have to use calculation integration to calculate the expected return. And we don't get into that, but I wish I could. Anyway, so this is the easiest you got. 3 states, those are the returns. You calculate expected return and the variance, taking the square root, you get the standard deviation. And as I said, so you should practice this. These are just from the notes that we discussed back here. Oops, not there. In the document that's not here. Ex post ex ante returns. So for practice or for recall, this is what we talked about. I gave you a data set and you had to calculate returns. In this case, the states of the world were normal, recession, and boom. So we could interpret the ones that I just saw the same way. We could refer to this as recession, normal, and boom. I mean, 1% isn't great, but we could do that. So this would be recession, normal, and boom, relatively speaking. So then you take this column minus the expected return that we calculated of 15%. And you square it. Should I do this in Excel? Or you guys have to do the work, because I kind of gave you a lot of stuff. I mean, I gave you a lot of resources. You just have to do the work. It's not going to go in your brain without practice. So Miguel's asking, what is this? It's good you guys are asking questions. It means things are coming together, I hope. They don't feel like they're coming together, but they should be coming together. So yes, average or expected return mean the same thing. Okay, so this is the expected return calculated. So the word expected return is reflects the one we're going to use as a prediction. So the expected return is the weighted average. This is the weighted mean. And the notation, if you go back and notice in the formulas I gave you, in the formula sheet and notation, I'm just using the notation from those sheets. But it's a weighted mean. So when you get data like this, you can go into Excel. You guys are pushing me. I feel like I gotta do this here. All right, so let's see. I'm gonna add another sheet, make this bigger. And so what we have are returns and probabilities, right? So this is P and this is return. And it's going to be 0.25, 0.5, and 0.25. So it's more likely this is the last time I do this for you guys. You guys have to practice making these calculations. And then the returns are -5 and I'm trying to read here. Okay, -5, 15, and 35. So -5, $15, and 35%. And I mentioned to avoid, well, I mean, it's probably better if I left them like this. The units are percent, but to make the calculations, I'm going to put them as decimals, -0.05. Because otherwise it can be confusing when you do the variance calculation. Uh-oh. It didn't take it, did it? 0. So I guess it'll do it automatically from 0.05. Sorry, the Excel is making me frustrated. Let's do this. I have to change the format. Excel's a little different in, I'm gonna have to do this somewhere else now. It's different in iPad. Just want the format data. I'll just do it over here. Start over. So 0.25, 0.5, and 0.25, and then -0.05 and 0.15 and 0.35. So that's the probability, and this is a return. And then what I want to do is PI times RI. Putting it in words because I have issues with the notation. And so then you multiply. So you say this column multiply this column, and you copy it all the way down. And then you sum. and you get your 15%. So this is the expected return. It's the average, weighted average. And now move it over. Now let's do I'm going to just copy it and start a new table for the variance and standard deviation. So let's do that. And what you want here is you want to take the probability, the deviations, right? You want to do deviations from the mean. So it's going to be probability times return minus expected return. I'm putting it all in words. You guys can look in your notes for the notation. You guys can be doing this along with me. So this is the deviation from the mean. And if you watch my standard deviation video, you understand what I'm talking about. So if you haven't, go back and watch the one that I was hounding you about watching. So this is going to be a matter of taking probability times bracket return minus, I'm going to just write 0.15 because it's the same all the way down, and close the bracket and then copy that all the way down. Didn't work. All right, so this is going to be a 0 because this is the same as the expected return. And then what do I do? So I have those, but that's not enough. I need to square those. So I have to do squared deviation from the mean. Actually, I'm going to put it on one. I'm going to put it here. Oops. I was supposed to do squared. And then times the probability, right? So let's do that and fix that. So first we put it to the power, and then that's always going to be 0. And there you go. Everybody with me? Let me see your comments. Yeah, I'm having, the thing is, it's Excel in iPad, and so I'm not used to the screen and the formats. I don't even see where it says format. So yeah, I have to set all this up. And that's why I hesitate to use Excel with you guys, because you guys should practice that. Okay, so then I'm going to sum, and I get what's called the variance. And that's the variance, and then the square root of that is the standard deviation of returns. And that's what you get. So you guys can do that. It's not a big deal, right? You guys can repeat that. So it's the average of the square deviations from the mean, weighted. And as I said, that's easy. If I did it more realistically, where I talked about infinite states of the world and all kinds of possible outcomes, you'd have to use, if you could do it discretely, that's one thing, but if the probabilities had a distribution, you would have to, like an infinite, like a formula, rather than just certain possible outcomes, but a formula that predicts the outcomes, then you would have to use calculus and integration. Okay, good. Let's take a screenshot because I'm going to go back. So all these calculations you can do yourself. And that's how I get the 14.14. Got it? All right, so that's for one stock, one company. That was review. Now, what if we consider two assets? Our goal is to make this as realistic as we can. In fact, investors don't just hold one asset, right? So when they look at returns for potentially buying stock or even selling stock that they already have, they look at a portfolio of assets and combining assets together. So we have to practice combining. So you never thought you'd use your statistics, right? But yes, you will. This is all statistics, really. So here we go. This is asset A. This is asset B, and I only reduced it to two states of the world. So it's either a boom, expansionary, or contractionary economy. And now I have two assets. How do I deal with that? What is the expected return of two assets? Well, it's the expected return as the weighted average of the two. Okay, so this is new. This is something, but it's the same calculation. So you would have learned this by something of learning the rules of means and variances in statistics, which if you haven't learned it, you're going to learn it now. So it's just a weighted mean. Putting these together, each for themselves. So we've done this already. So I multiply this times this, and then this times this, and then I add those. And then I do this times this, and this times this, and then I add them. That's what this is. So asset A return on average is 6%, and asset B return on average is 7%. So this is nothing new so far. And now we can get the variances for both of them. So A is, when I calculate the variance, you can use Excel to do it, or you can just see the math here. A's returns on average with a variance of, I have to take the variance, and then I take the square root of the variance, and that gives me this differential. So for A, it's 19.6, and for B, it's 22%. Now remembering, what were A's and B's returns? That was 6 and that was 7. So just to make a note, this is the notation. I used ERA, right? So the expected return. So again, why am I using all these different fancy symbols? Remember, it's because I'm giving you a distribution. When I give you a distribution, you use the Greek letters. But essentially, this is standard deviation, and this is the mean. I hope you can read cursive. All right, so this says, this notation is in Greek letters, right? I use sigma and I use ERA. It looks different than what we've done with X bar and S because I've given you the data, the information, as a representation of the possible outcomes of the population. So because of that, I use the Greek letters. All right, so what do we see? Let's do the finance. So that was kind of just statistics. Now let's do the finance interpretation. Notice the higher the return to compensate for the higher risk. Okay? So when you look at these two assets, what can we conclude? Which asset is preferred by a risk-averse investor? A risk-averse investor needs to look at the trade-off between risk and return. As I've mentioned, a higher return asset is also accompanied with higher risk. So one way to look at this, distinguishing first between types of investors, right? Risk-averse, want to avoid risk, risk-loving, take on risk willingly. These are different classes or types of investors. By definition, a risk-averse investor, when presented with two securities with comparable returns, will choose the lower risk security. And risk-loving, when presented with two securities with comparable returns, will choose the higher risk security. How do we put this together? I propose that you can combine the risk-return trade-off by thinking about the risk, put it on the numerator, and spreading out the risk over the return. So what you're kind of doing is saying, you know, how much risk am I taking on for the expected return? So this is a good thing, this is a bad thing, right? I want to spread it out. So if this is really high, the denominator is really high return, that spreads this out and lowers the risk per unit of return. So what you do with this is called the coefficient of variation. What you do with this calculation is a way of just demonstrating the trade-off and taking note that we like return, and if it's higher, it'll reduce the risk, and if it's high enough, it'll appear that it's lower, right? So the coefficient of variation will be lower for B than for A. So an investor that is risk averse and doesn't like risk will look at this trade-off and say, well, I want less risk in terms of coefficient of variation per unit of return. This is lower risk. I'll go with B over A. And the risk-loving investor will gravitate to the higher risk asset using this kind of metric of comparing or weighing the trade-off between risk and return, and we'll go with asset A over B. Okay, so it's a way of putting together the tension, resolving the tension between choosing between these. First, you got to know what kind of investor, risk preference they have or risk tolerance they have, and then combining this is like the cost and this is the benefit. You're doing cost over benefit, and you want, yeah. It's a way of looking at, so it couldn't feel like how we were looking at different ways of valuing cash flows, right? And we looked at the net present value, and then I did the internal rate of return, and then I did the profitability index. That's where you're dividing the actually that's benefit over cost. It's like bang for your buck. It's the reverse, but don't let that confuse you. Just realize what we're doing here is spreading out the risk over every unit of return, expected return. Okay, so let's go on now. Now we're at the new stuff. So this is the new stuff. All that was review. And here we're going to use the rules of means and variances to derive our results. Now I gave you, almost had 3 weeks to review statistics, so you got to be with me. I really do. I'm going to assume it. So what we're going to do now is we're going to combine assets into a portfolio, and we're going to begin with the simplest case of just two. With two assets, how do I combine them? Well, it depends how I combine them. So let's say I have $1,000 to invest, just because it helps people think this through. So for the $1,000 to invest, we're going to invest 500 into A and 500 worth of stock in B. So I'm sticking with talking about risky securities, okay? So we're talking about two different stock. And it turns out I'm not going to use the dollar figures right now, but I'm going to invest 50% in A and 50% in B. Then the portfolio of expected returns would be, well, this says the expected returns to RP. What's RP? RP is these are variables, right? The returns. Return A and return B are variables, and I usually give you a table of values of the possible outcomes and then their likelihood. So these are variables, and what I'm doing here is I'm combining in a portfolio the two variables or the two assets, right? And this proportion. So I'm going to have a fraction of A and a fraction of B. Now what I want to figure out is what is the expected return of that. So the rule is the average of a sum of variables is the sum of the average. So let me put it in words if that helps. I'm going to call it the expected value because it's screaming at you, right? The expected value. It has an E there. So it says the expected value of a weighted sum of variables is the weighted sum of the averages, of their averages. The expected value of a sum of variables is the sum of their weighted averages. So a simpler way, it would be the average of a sum is the sum of the averages. It's harder to see because you have this X here. You have to remember something about this XA. XAs are weights. XA plus XB is equal to 1. They're both less than 1. It's a fraction, but particularly less than 1. So, what about the exercise that we just did with A and B, security? We had A's was 6% and B's expected return was 7%. So what is the weighted average of combining A and B 50-50 into a portfolio? Well, it's just going to be the average of these, the weighted average. In this case, we use 50-50 to make it easy, but it's just going to be the weight, 50% of A plus 50% of B. Which is just like averaging them, because it's 50%. It's just like 1/2 of 0.06 plus 0.07. That's the same thing. So it's 6.5. So this is just 6.5%. Oops. Right? Which makes sense. So half of those is just halfway in between 6 and 7. What about combining assets A and B now and their variance? What happens to their variance? And students sort of freak out because this looks so weird. Lots of notation here. You don't have to recopy this notation. You have to care about what it says, what it means. This is a part of this long formula here. What in the world is happening? Well, back to this for a moment. For the rules of means, the expected value of a weighted sum of variables is the weighted sum of their averages. Or expected values, maybe I'll write it like that so you can see it. Of their expected values. So let me say it simpler. The average of the sum is the sum of the averages. The average of the sum is the sum of the averages. And so these are the averages for each one, but I have to sum their average, and I do a weighted sum, or weighted average of the averages. I guess it's confusing because it's averages of averages, but don't let that bother you. Once you see the numbers, it's a little easier to follow. So what about variance? Is the variance of a sum the sum of the variances? This is my question. So when is the sum of a variable, the variance of a sum of variables is the sum of the variances? When does this happen? So in other words, you see this here? When is this the case? When is this true? Very simple result. And you're going to say, why are there squares? They're squares because, remember, we do a squared deviation from the mean, average squared deviations. Anyway, I'm going to get to that in a minute. But because we square to get the variance, we square deviations, we end up squaring the weights. Everything gets squared, and then we take the square root for the standard deviation down here. Okay, so back to my question. When is this true? So if you never learned this before, you're learning this now, and you need to know this forever. But when is this true? Does anybody know? If you look at the formula, this will be true when this part disappears. What would make this part disappear? What is this? This is the symbol for covariance. Covariance looks like this. What's covariance again? Covariance is a measure of unstandardized correlation. It picks up the direction of the linear relationship between these variables in a scatter plot. You can visualize the scatter plot. So this will be true when there's no correlation. What does it mean, no correlation? When there's no relationship between the assets A and B, there's no trend, there's no pattern. In other words, they're independent. I'll just stick with the word uncorrelated. Well, this basically means uncorrelated. So saying the correlation is 0 or the covariance is 0 is saying they're uncorrelated. So if there's no covariance, then this is true. If there is a covariance, that you add this extra term. So you'd actually have to calculate the covariance. And a couple of weeks ago, I gave you all those handouts to practice calculations. You calculate the covariance and it goes in here. So then you take the standard deviation. So let's calculate this for this problem, and then I want to go a little bit, I'm going to explain where this comes from if that helps. So you're going to need A's variance, B's variance, which we already have, right? We already calculated those. And then you need the covariance. So you need to make a table to calculate that. Let's see if I give you the value here, but let's see if we can put it in the table. Make things easier. So I have all these numbers already. Okay, no, I'm going to take these numbers and put them in Excel. So I'm going to put these in Excel with probability. Oop, didn't work. And then return. And I have to put 2 columns now. Return to A. I'll just do it like this. Does that make sense? Let me do it this way. And so we have 0.4. So these are the possible states. So this is different than the weights, okay? The states of the economy are different than the weights of combining 2 assets. So there's lots of probability. Everything's like a probability or a fraction. So be clear about what you're dealing with. This is, these are the percentage returns. And let me know if I make a mistake, although I can't see the screen right now. 0.25. And now we can get the expected return. I can do the formula right here. I won't do the long formula. I'll just do so this would be this times this plus this times this, right? And then for B, it's equal to, again, probability times the return plus probability times the return. And those possible states have to sum to 1, right? These have to be 1. So those are the numbers we already recognize as the expected returns. Now the variance for each of them, we already calculated, but I need it for this. So let's do the columns. This is going to be A minus E return to A. If I use a little a, I'm doing words because I want you to follow. So that's the column for expected return. And then I'm going to do the same thing for B. So these are the deviations from their means. And if you didn't watch the video where I talked about this, I did this last class, watch it again, or watch it if you never watched it. So we're going to do the deviations from the mean, which is just this return minus 0.06 all the way down. And then I'm going to do the same thing here. B minus 0.07 all the way down. And then I'm going to do the long, going to pre-multiply them and have the deviations from the mean of each, right? So this is going to be equal to probability times, I'll just write it like that. And what I want to do is each of those if you're bored, you can let me know so I can stop doing this, but I feel like I'm going to save trouble if I do this now. Oh, I don't want the formulas, I just want to write the words. Okay, so what you're going to do is multiply and we did talk about this last class. I'm going to take the probability and I'm going to multiply by the deviation from the mean there and the deviation from the mean, not that one, the deviation from the mean of B, And that's it. And I'm going to do it the same formula all the way down. And then I'm going to sum. Uh-oh. What did it happen here? Oh, no, I don't have anything there. Sorry. And then I'm going to sum those. And I feel like I got wrong answer, but let's see. Let's see. Okay, let's go back. So let's see, what did I have here? So covariance, I'm supposed to have a negative. Did I do something wrong? Covariance. Oh yeah, I got the no, I didn't. 0.04. I know it's a negative. That's why I'm okay. There's the number. So what did I do wrong? Oh yeah, I just got this term. Yeah, I got it. Let's see if I got it. Yes, you see? That wasn't so hard. So that's where that magical number comes from. Negative 0.0432. Everyone can see this? So that wasn't a big deal. In Excel, it's pretty clear. Everybody good? No questions? You can do this? So now, what do? So I found out that they are not zero. It's not a zero covariance between them, that they are correlated, and they're negatively correlated. So they're negatively correlated. So I have to use this. It's not just that the variance of a sum of variables is the sum of their variances, or that the variance of a weighted sum of variables is the weighted sum of their variances. I actually have to add this extra term in because there's a covariance between them, their returns. So this scary looking thing is just what I did. It's not a big deal. So this is instructions, right? This is like instructions of what you're supposed to do that I just did. So then what we want to do is put all of this together, is the variance, and then take the square root. So we got to do that. And remembering we already calculated these, I'm going to put them, so you should practice this. I put it all together in this long formula, and then I take the square root. And you see, it's very small. And then this is very small, relatively small. So statistics is about averages and relative measures. Everything is relative. We have to compare this to what? Remember, the return on A was 6% with a standard deviation, and the return on B was 7% with its standard deviation. And we saw that B had a greater standard deviation or greater risk than A because, well, it has to do with the fact that it's riskier, so there's a higher return for investors to purchase that asset. So it's 19.6 for A and 22 for B. So this was 19.6 and 22. Way outside the range of this. So what happened was, by holding assets that are negatively correlated, I reduced the risk of the portfolio relative to what it was to hold assets individually. If I took A, it's much higher. If I took B, it's much higher. But combining them, holding them together, 50-50, I've offset the risk inherent, because if you look back, which we haven't done, you should always do is sit back and look at your returns. You can see it. What do you see? You see when A does well, B does poorly. And then when A does poorly, B does well. Okay, so in a boom state, asset B's returns, the negative returns are offset by asset A's high returns. And in the bust situation where A fails, B is counter, anyway, it just does well. I'm trying to think of it's like contrarian or counter market. Okay, so it does very well. So that is what you see with the data, right? And so it's picked up when we make our calculation, and the effect is dramatic. Look at that. So we can take advantage of a diversification. This is diversification, assets that behave differently with, negatively correlated, to compensate one for the other. This is called diversification. So diversifying can help reduce risk. Questions so far? I want to take a moment to talk about this formula so it's not so scary, or I don't know, students just don't like it. I'm going to show you where it comes from. Very simple way that you will not forget. And then you can also use the logic that I demonstrate to infer or deduce what happens for more than two assets. The N assets. Should there be a similar pattern? Let's say I had 3 assets. What would the formula be? Can you figure it out by just looking at this? What should the formula be with 3 assets? So let's see. This is the formula for what I'm going to do now. It represents what I'm going to do now. So if I put, let me put in another page. So what I'm going to do is think about combining into a portfolio where A and B are the weights, not states of the world, but they're fractions apportioning my investment dollars partially in A and partially in B. So I'm going to put the weight of returns on A and then the rate of return on B. And I want to consider all variability associated with these variables. So what I'm going to do is I'm going to think about the covariance of each variable. So this is like a new variable, not RA, not the returns on A, but XARA. Okay, so when you do that, you pre-multiply by a weight that's less than 1 by RA, you just get this new variable that's just XARA. So I'm going to think about the variation in terms of covariation between XARA and XARA. Then I'm going to do the same thing here, covariance of XARA with XB. Oh, that's supposed to be an RB. I made a mess of that. So just watch me and take a screenshot after, and then you can do it manually if you still don't get it, which is a good idea. So then I'm going to combine. So I'm reading off this matrix, right? I'm going to take the variable XB, RB, and covariance with XARA. So you always take this one first, right? You always take the row first. The row, and then I'm going to covary that XB, RB, XB, RB. And now you're going to tell me how I can simplify this. What is this? How do I simplify that? So let's think about our covariance formula for a minute. So covariance of XARA is just, well, think about, I'm going to just put, at the risk of confusing you, no, I better not do that. I'm going to stick with this notation. I don't know if I should stick with a notation. Actually, what I'm going to do is I'm going to go and talk about for a minute something that looks more familiar, because this might not look so familiar, is to work with X, right? So this is like what's covariance of X with X? Somebody better tell me. What is that? If I write it like this, you can see it better. What is that? Come on. What is that? I'm going to yell at you now. What is it? Are you there? I'm going to take a break after we get through this matrix. Somebody tell me. What is this? Right, this is the variance. This is called the variance. Very good. Very good. This is called the variance. So the covariance of a variable with itself is the variance. Got it? It's the variance. Okay, you guys got to go and study your statistics that I gave you, because I've given you 3 weeks of that stuff you guys need to practice. So this is the variance. Everyone sees that now? So the covariance of a variable with itself is just the variance. So then what's this? This is the covariance of a variable with itself. My question will be, what do I do about this thing in front, though? What happens with this? Let's continue with our example. Oops. Let's continue with our example, going back to something we recognize. Oh, this drives me nuts when this happens. Okay, can I move this? Move. All right, so So we see that this is all about patterns. This is not even mathematics. Well, mathematics is patterns, but we're looking at patterns here. So covariance of a variable with itself is the variance. And now the question is, what is the covariance of something in front, a weight? I can use A, I'll use a small a. What would this be? That's basically what we're dealing with. So this is the, so you got it so far. Covariance of x with itself is just the variance. This is covariance of a pre-weighed, like something in front here, with itself. So some portion of x. So what is that? Well, let's put it in the formula. Let's put it here. Or I'll just write them both down. Oh, and I forgot. If this is, what did we just learn about the mean? If we multiply something by a variable and we talk about its average, then the average gets multiplied by that thing. So let's see. The average, the weighted average of the means is the means of the weighted averages. Anyway, there's an A here. I'm not giving up on you guys. I'm going to make sure I cover this and then you have to review it. This would be like this, just because of what I taught you about the means. There would have to be an A in front there. And then what happens? Because of that, I can factor this out. There's an A here and there's an A here. So we're going to factor those two out and there's going to be two A's. So what this means is the covariance of AX with AX is just, so this is the pattern you have to remember. It's just A squared because this comes out of here. And then variance of x. And in our notation, what we write in terms of this notation is we write xa squared sigma a squared because it's variance. And that is the pattern. So what I did differently is I wanted to go back to this formula because this is easier than having the P's and the R's and all those letters, E's and too many letters. It gets confusing if you don't know what's happening. So remember this simple case. This is what you're doing when you calculate covariance. So if I put a letter in front, all that happens is it doubles, well, it multiplies. So you have an exponent of 2 because you had 2, and that's variance. So in terms of this notation with the Greek letters and these weights called XA, it's just XA squared sigma A squared. Does anybody follow? Anybody follow what I'm doing here? So there's a pattern. The pattern is that this becomes XA squared sigma A squared. And then this one below, this one becomes xb squared sigma b squared. And then this one is going to be x B XA covariance RBRA So you're seeing the pattern? Oops. And this one is going to be XAXB covariance RARB. And I'm going to ask you the next question. Are these the same thing? Aren't these the same thing? Does it matter if I put XA times XB? These are just fractions, or not numbers, percentages less than 1. Or weights, these are the weights. Does it matter if I multiply A first and then B, or B and then A? That doesn't matter, right? And even with the calculation of covariance, it doesn't matter if I put RB first or RA. So these are the same thing. And how many are there? There's 2. So what I have just derived for you is the formula that captures all the variability for RP. RP was XA, the return on the portfolio, P for portfolio. That is not what I want to write. It's going to put the weight on A and B. And so you get the result is not just the sum of the variances, but you have the extra term because there's 2 portions of variability. There's 2 with the weights in front, XA, XB, and covariance of RA, RB. And you can tell me if you have any questions. So all I'm doing is showing the final result. And in this way, you can do this for 3 variables, 4 variables, 5 variables. So a portfolio of N stock, same pattern. What you have to remember, you're just going to extend it one more term, and you have to consider all the portions of variability. What's going to happen is there's always going to be squared terms with the weights squared, and then you have to consider combining each asset with the other in turn. So you have to go A and B, A and C, B and C. I'm not going to do it because we don't have to do it, but for this class, but you can see you use the same approach to add one more variable, one more column, one more row, and you consider the same logic. Okay, so that's where that formula comes from. If that helps, that's great. Let's take 5 minutes, and after 5 minutes, you guys can ask me questions, or you can ask me questions now.